So in this video, we're going to look at the reality of retail investing. So the retail investing process, the interaction you have with those who will do this work for you if you invest through a third party, goes something like this. You will accrue savings in your bank account or wherever else you choose to save, and eventually you'll feel like you've got a big enough pot of money to go and invest in something that pays a better return than your bank account. And once you've got to that stage, you may go see a financial planner or a financial advisor. They're the people, the third parties in the market who will help you invest in the stock market if you don't know how to do it yourself. And what you do is you sit down with those people and you go through a fact find process. And there's a couple of aspects to that fact find. One is your attitude to risk and what sort of things you may or may not like investing in. And the other aspect of it is, how many years you've got to go till the point where you want to take some money out of your fund. And the classic example is when you want to retire. So what fund do you want to achieve by the time you retire? And what do you want from that fund? What income are you looking for? And once the advisor's gone through that process with you, what they do then is they go off and they do some rules-based research around what they've found out about you, and they're trying to find the investments that the rules of the financial services industry would recommend that they give to somebody in your position. And so they will come back to you eventually when they've done that research with a recommended investment plan. And what usually happens is, because you've gone to them because you don't know anything about the market and what sort of things you should or should not be investing in, they will recommend a plan to you and you'll accept that recommendation. So if you accept that recommendation, what then happens is you hand your savings over to them to manage for you in the way that they've suggested, and they will place your money within a wrapper. It might be a pensions wrapper if it's a pension, it might be an ISA wrapper if it's an ISA, it might be another kind of investment product, or it might just be a basket of stocks. But whatever you've asked them to do, whatever service you were looking for, they've created that plan and that operation for you, and you invest your savings and you hand that money over to them to manage. Now, the next thing I want to talk about is just what the rules and the processes that they go through mean for you and your investments. And you can see we've got a graph here, and we've got the return in percentage on the vertical axis, and on the horizontal axis we've got your attitude to risk that was found out from the fact find. And if we assume that this dotted line that goes from left to the right is the 0% mark, then I'm going to add a couple of lines to this graph, and the first one here is a green line, and that's potential returns to the upside, and then this red line is potential returns to the downside. And let's talk about a risk level of 5. Let's just put a risk level of 5 on the chart here. Now, if we take that risk level of 5, we can then look at the potential for return to the upside and the potential for return to the downside. And I'll put some numbers on the chart now. So that's plus 25% to the upside at a risk level of 5 and minus 15 to the downside. Now, what does this all mean? This means these are the returns in an individual year. So not the returns you'll get every year, but these are like the best returns that they're expecting from a risk level of 5 with what they've recommended to you, and the worst returns. Now, there is a tolerance here, because obviously people do occasionally, in circumstances like market crashes, they do experience a loss under 15% in a certain year. So what they're trying to do is they're trying to stay within this tolerance 90% of the time. That's what they're trying to do. So what they're saying is, an individual year, 90% of the time, there might be an upside that goes as high as 25%, but they wouldn't expect any more than that. And in an individual year, they might expect a minus 15%. But 90% of the time is the tolerance for that, and occasionally obviously it's going to drop outside that the other 10% of the time. And the same with the returns to the top side, it's possible. Yeah, so that's what they're expecting, and there is an average here that I'm going to tell you about now. So that's what can happen in any individual year. But before I move on to the average, I just want to ask you one question. Has your financial planner or advisor, if you've gone through this process, ever said to you that a risk level of 5, which is the average and is what a lot of people are, who don't want too much risk in the market but accept there is some risk, the average is obviously 5. So this will cover a lot of people who are listening to this. So this may be, you've got a risk level of 5. Has your financial advisor ever explained to you that in an individual year they're quite happy with the investment they've recommended to you? That would go to -15 and it wouldn't bother them in the slightest, because that's what they're expecting from it. And I suspect that you might be quite shocked at that. I certainly know that if I speak to groups of people, and I speak in the classroom about this a lot, I speak on stage all over the world about this, and when we bring this to attention of people, most people have not a clue that a risk level of 5 would leave them in a situation where in any individual year they might be expected to lose up to 15% of their investment. Okay, and they certainly wouldn't have any expectation that outside of that it might go a lot lower, because that's only 90% of the time. So it's important to understand that you sometimes don't hear all these rules behind what people are doing for you and don't fully understand the process. What you're more likely to have heard of is more likely to have heard of the returns the funds that you invest in have made in the past. That's the thing you're most likely to have heard from your financial advisor. Let's look at the averages now. If we look at the averages on a risk level of 5, although the upper return is 25%, in that tolerance of 90%, and the lower return is -15. The average actually of all the returns, if we look over a much longer period, which is 10, 15, 20 years, the average of all the returns is actually 5% at a risk level of 5. And if we went to a risk level of 10, which is as risky as you can get, if we go to a risk level of 10, then what we've got is we've got an upper return of potentially of 45% and a lower return of -30, but the average of all the returns is 7.95. So this is interesting, isn't it? You've doubled your risk to the maximum and yet you haven't doubled the average return, which is quite surprising if you think about it, that you would take on all that extra risk for another 2.95%. It's not even double what you were looking at. But there's a further aspect to this, in that when you've got those averages, there are some charges in the retail investment process. There are some charges which are levied on your fund, and they're levied by your financial advisor and they're levied by your fund manager. And those charges on average are 2%. They have a range and we'll talk about that later, but the average is 2%. So if we took the average person at risk level of 5 and said, what are they getting each year from their return in the stock market if they go through a third party, they're actually getting 3% net return. And if we look at the average at a risk level of 10, they're getting, when you've taken the 2% charges off, they're getting a return of 5.95%. Now, potentially that's probably very sobering for you, because after I talked about a potential of an upside in any individual year 25% or 45% risk level 10, you probably thought, oh, that's not too bad actually. But the averages show the true reality of the situation. So here's something important to understand. When I'm saying that you can outstrip the returns of your fund manager with what I'm going to show you, when you look at those averages, you can see now that might be very possible. Now, there will be individual years when a fund manager will outstrip probably what you can do as a private investor. But here's the key thing. Research shows that most fund managers do not beat the market consistently. So they may beat the market in an odd year, and you can bet your bottom dollar that those are the years your financial advisor will be showing you, because they'll be showing you the most impressive years, won't they? That's only natural. They're trying to show you how good the fund manager is. But the reality is that none of those fund managers consistently beat the market. And so if they beat the market some years, they might be under the market other years. So if you just concentrate on getting the average of what's achieved in the market, but you actually remove some of these charges, you can actually just boost your returns over and above a fund manager by getting rid of these charges and just having a more consistent performance. Not losing that average of 2% every year from your fund can make a huge difference to your returns over time, and that's where your edge is as a private investor. I hope you've enjoyed looking at the reality of retail investing. I hope you've seen now that there's a real opportunity for you, and you can see what you should be expecting from that retail investment process. And the last thing I want to talk to you about now is, if you think that the average person is at a risk level of 5 and the average return that person can get from their funds in the stock market through a third party is 3%, I've got a question for you. If you are looking at retiring and leaving your money in the hands of a third party at retirement, which is what most people do, get an annuity, if an annuity is going to pay you 3% on average, that means that in order to get £30,000 worth of income in retirement, you need £1 million fund. And obviously, if you're in the US, if you're looking to get $30,000 a year income, you need $1 million fund. Now, if you actually go and talk to your financial advisor and say, how big are you expecting my fund to be at retirement, you will probably find that it's very difficult to build your fund to $1 million within the realms of the financial process, unless you're putting a lot of money into it, a lot more than you probably are. So that's a key question to ask your financial advisor. Am I going to have $1 million fund? And if you obviously, if you want a bigger return per year than what I've suggested, which is $30,000 a year, then you need an even bigger fund. And most people just aren't going to achieve that. So you need to do one of two things. You need to find a way of getting a higher return out of the stock market, or you need to find a way of building your fund in an accelerated way. Or perhaps you could become a private investor and you could do both. You could find a way of producing more income from the market, and you can also find a way of building up your fund quicker. And all that involves is removing these charges and becoming consistent in the market. Removing these charges, becoming consistent in the market, and then if you add income to that as well, which is something that you can do through the levels of stock investment mastery, then you can boost this in a huge way from what we're looking at right now in the retail investing process. So that's the end of this video. I'll see you in the next video.